If you had 5 minutes to ask a very experienced investor their views, what would you ask them? I am being handed that task today. I'm joined by Peter Fitzgerald. He's the CIO of the multi-asset and macro area in Aviva Investors. So looking after 40 odd portfolio managers and investment research analysts. I know that you've been managing portfolios for 20, 30 years, Peter, yourself. So I'm really interested to learn as much as I can in this 5 minutes. And I think where I want to go with this is to ask some of your kind of longer term views and what you've learned in that long experience that you have. So my question is, what are the 3 lessons you've learned as an investor over that period that you would like to share with our listeners?
Yeah. Okay. Thank you, Shane. So I think the first one that I would highlight is the importance of having a high degree of humility. And what I mean by that is, in the moment when you're making investment decisions, you don't have all of the information. And particularly with the benefit of hindsight, when you're looking back on events, they can seem much clearer and much more obvious than they were at the time. And the way I would recommend people combat that is to keep an investment diary. And particularly during extreme periods in history. And one of those was during COVID. So people look back at COVID and they go, well, it was completely obvious that governments were going to step in, that the pandemic was going to recede, and you should have been fully invested as markets crashed. But I think unless you kept a diary and wrote down what your thoughts and feelings, emotions and outlook was at that particular moment in time, your mind will play tricks on you. So I would combine humility, and the only way to deal with that is recognize that there's a lot of stuff you don't know. Don't fall into hindsight bias and keep an investment diary. That would be the
Love
first.
that. Stay humble. Okay. I remember you specifically talking about that investment diary at the time, the fact that you were keeping it, which I thought was unusual, and then referencing it a year later. And you're right. It is so interesting to look back at the tricks that the mind played at the time. Number 2.
So the second one I would say, and again, this one, for some investors, this would be obvious. For others who've got quite flexible mandates, it might be trickier. And really it's to stay invested. And the example I use here is some of the portfolios that I had the privilege of looking after in 2007, 2008, did really well because for whatever reason, I kind of saw the financial crisis evolve, and I knew just deep down that this was going to be worse than most expected. So the portfolios that I managed were very defensively positioned and basically lost no money through that bear market. The challenge was through 2009, when markets rallied strongly, I didn't make any money either because I'd become so negative and hadn't clearly identified what was it that was going to be the trigger to get me back into markets. So net clients probably did okay. They didn't lose that much money on the way down, if any, but also they didn't make any money in the recovery. And that's a really difficult place to be when markets are rallying and you're not making any money for your investors.
Yeah, I love that. And I know you've talked quite a bit about that point about really understanding the catalyst to get back in. At the point of deciding when to move out of the markets, understanding what it is is going to make you jump back in again, which is, as you say, so important, or else you could be stuck on the sidelines. Number 3, Peter.
Yeah, number 3, and this deals to some extent with emotions and sentiment, which I think are a really big driver for markets. And my recommendation is people read less news. And when they do read news, recognize that they are the product. It is their eyeballs and their attention and their time that's being sold to advertisers. News outlets are not necessarily there to inform you. They're there to grab your attention so that they can sell your attention to advertisers. And to some extent, that goes for investment advice that one may read in newspapers and media outlets. So any prediction that you ever see, you need to ask somebody, what's the probability that you associate with that prediction? And crucially, what's the time frame as well? Because if I turn around and say to you, Shane, I expect markets to crash by 20%, and unless I provide a time frame, I'm pretty certain that over the next 20 years, and hopefully I'll still be managing money, the markets will crash by 20% at some point, and I can highlight that I made that prediction.
So true. And I think the point on media and news is so important right now because you're hard pressed to find positivity at the moment. There are 25 reasons to be negative. But as you mentioned, taking a long-term view, remaining invested is usually quite a good idea. Not that we're giving investment advice today, but I think these are really solid grounding lessons that we've heard before, but really good to hear from someone like yourself who's an experienced investor. Peter, that was excellent. As always, we always put a fund manager on the spot. It's usually somebody on your team, but it's great to have you in the hot seat this week. We will be back next week. We will put somebody else on the spot. We'll ask a difficult question and we look to wrap it up all in about 5 minutes. Until next week, take care.